Howdy, y'all. Welcome back. It's the weekly wrap up for January 7th, 2022. Hope everyone had a great week. It's been pretty nice here in Colorado. Lots of sun, had a little bit of snow. We're due for another little bit of snow tomorrow afternoon on Saturday. I guess Saturday afternoon and evening. So nothing too bad. I think we'll probably have 1 to 3 inches. So nothing too dramatic. So my front yard is still covered in snow, but parts of if you get a lot of sun on your property, it's pretty much cleared up. So if it's your first time watching, be sure to like, subscribe, and share with friends and family if you think they might get something valuable out of all my ramblings. Definitely been kind of a boring week in the markets. I mean, Monday seemed like everyone was still taking the day off from the holiday weekend. And, most of it's just been kind of hand wringing about what the Fed's going to do over the next couple of months. So we'll see what goes on. So let's go ahead and get to the news. All righty, here we go. Let's take a look at the major world indexes. The Dow Jones was flat today. It was down 0.01. The S&P 500 was down 0.41. NASDAQ down 0.96. Small caps down 1.12. The VIX was down 4.33, down to 18.76. So that is some good news. I mean, even though the markets were down or flat, to see the volatility index recede a little bit is definitely a positive sign for the time being. Let's take a look here across Europe. Kind of mixed. The DAX was down, the FTSE was up. So it looks like Europe was kind of mixed. And let's go down here to Asia. Kind of a mixed bag. Nothing too dramatic. It looks like the Hang Seng was probably your best performer at up 1.82. So, all right. Well, let's look at and see how the indexes did for the week. All right. So the Dow Jones looks like for the week was down about 0.21. The S&P 500 down about 2.13. NASDAQ down 4.82. Dow Utilities down 0.79. And the Dow Transports we're down 1.35. So looks like across the board here from the U.S. indexes, it looks like they were all down. From anywhere from less than 1% down to in the case of the Nasdaq, it was down almost 5%. So not the best week domestically, but again, with a lot of the uncertainty with what's, on our horizon, it's certainly not shocking at all. So let's take a look at, let's see here. All right, let's take a look at the jobless claims numbers that came in this week. Jobless claims came in at 207,000 against a forecast of 197,000. So 10,000 over forecast. So not too shabby there. Like I said, looking back historically, we're back as far as the the initial jobless claims numbers. They look like they're back in line with where we were before all this started. Continuing jobless claims numbers came in at 1.754 million against a forecast of 1.688 million. Again, this looks pretty good. It did tick up a little bit from the week before, but still not the end of the world. And again, looking back to 2 or 3 years ago, we're right back where we should be. Now, let's trade economics. Let's take a look at. Let's see here: markets, calendar, news, countries. United States, probably should have done this before. Labor, unemployment rate, employed persons. Here we go. Here's the chart I wanted to see. All right. So if we go back and look at a 25-year chart, we can see right here we're at 155.975 million employed Americans. And you can see 2 years ago where we were. We were, 158 ish. So we're still off by about what was that about? Probably about 3 million Americans are still out of work, even though, you know, the jobless claims numbers are back where they should be. So, there is some disconnect there in the economy. So it does, lead me to have a little bit of concern. Why are there still so many people not back in the workforce? When I don't think 3 million people died of COVID over the last 2 years. I think that number is much lower. So what's the deal with that? So all right. Let's look at the next report here. U.S. Job Openings and Labor Turnover Survey, the JOLTs Job Openings report came in at 10.562 million. The forecast was 11.075. So again, a little bit of a step back as far as job openings. But again, we still, there's 10 million jobs out there. There's 3 million less people in the workforce than there was 2 years ago. And I don't think the population shrank that much. So, again, that's where the problem is in the labor force. We see, if you go out to restaurants or stores, there's help wanted signs everywhere. Here locally in the Denver area, the local Kroger chain is in the middle of a labor strike. So I know that's going to cause problems at the grocery stores. So, and there's not a lot of choices here. You either got Safeway or you got the Kroger brand stores, which is called King Soopers. And there may be a few others here and there, but those are the two main ones. So you either get one or the other. I personally, being a former Kroger employee, like Kroger, but the last time I was at the store, I guess that was at the beginning of the week. The shelves are empty. The meat department was cleaned out. I know it was, post holiday weekend, but I think they're really short staffed. All right. Next report is the U.S. ISM Manufacturing Purchase Managers Index. Came in at 58.7. The forecast was 60. So we do see that it has receded a little bit from previous months. So is it the end of the world? Nah, it's not a huge drop, but again, it is it does look like things are slowing down slightly. All right, next one, factory orders month over month was up 1.6% against a forecast of 1.5. So again, that number is up, which is a positive sign. Let's look at the U.S. ISM non-manufacturing purchasing managers index. Came in at a 62 versus a forecast of 66.9. Previous number was 69.1. So again, a bit of a pullback in that index also. So you're welcome to go through and read through what all the details are. But it does look like things are starting to slow slightly. All right, U.S. non-farm payrolls came in at 199,000. We were expecting a forecast of 400,000, so about 50% less than what we would like to see. So again, looking back historically, these numbers, they're either way off or like right on target. It's just very strange. Looking back, for the last really the last year, we've had a number of months that really missed the mark badly. Like May came in at 266 versus a forecast of 978. September came in at 235 versus 750. October 194 versus 500,000. December's numbers came in at 210 versus 550. So I don't know. Is it a matter of the forecasters just being completely off? Or is it just, it seems like some months there's huge numbers and then other months, not so much. So, it'll be interesting to see longer term what this turns out to look like. All right. And the unemployment rate is officially at 3.9%. The forecast was 4.1. So you can see that in the last month, we've dropped, about 30 basis points from December to January. So again, good news that the unemployment rate the unemployment numbers look much better than what they were a year ago, and definitely 18 months ago. But like I said, there is that disconnect between who's working and who's looking for work. So, all right. Well, I have a couple of articles I want to breeze through today. Let's see, we're at 10 minutes here. This first one is Will investors go along with a weaker Fed put? And this is by Mohammed El Arain. He is I looked up his bio a minute ago. He's the president of Queens College and Cambridge, and he's, I think, the chief economist at Allianz, if memory serves correctly. All right, let's dive into his opinion piece here. Many of you viewed the pullback in markets this week, including the sharp fall in the NASDAQ, as a reaction to the release of the Fed minutes from the Federal Reserve December policy meeting that were more hawkish than expected. That raises two interesting issues for markets and the economy. Why were investors taken by surprise, and what were the implications of future price moves? The market moving aspect came from higher combined probability of three policy moves in 2022, the end of large-scale asset purchases, a series of interest rate increases, and the possibility that the Fed will start to reduce its balance sheet. I don't know why those are all considered bad things. I mean, anyone who's been paying attention knows for damn sure that we have to raise interest rates to get the inflation under control. And I mean, do people think that the Fed is going to continue to buy up toxic assets forever? I mean, come on. All right. The catalyst for this was twofold. The recognition by the Fed, albeit a belated one, that inflation has and will continue to be higher and more persistent than what it was expected, and therefore well above its target. And the judgment of the labor market will soon meet, if it hasn't already, the second element of the central bank's dual objective, that of maximum employment. Given some economic data in the run-up to the December Fed meeting, let alone what has come since, neither of these two contributing factors should have come as a great surprise to the markets. I mean, I wasn't surprised. The fact that they were can be attributed to another less than full alignment between the content of the FOMC discussions and how they were portrayed in the press conference that immediately followed. This is particularly the case for the treatment of a potential contraction of the Fed's balance sheet. Looking ahead, what happens next will depend in large part on whether the evolution of inflation and employment validate the now more hawkish expectations. While the Fed still has a window to deliver an orderly policy normalization, there are two reasons this opening is uncomfortably tighter than it was a few months ago, or even or ever needed to be, considering my repeated advocacy as early as April of last year for the Fed to start its tapering process. I think I've been complaining about this probably for greater than a year. Granted, I'm just a nobody sitting out here as a financial advisor. This guy is a little more clout. So if he's been bitching about it, I can't imagine that, or I imagine somebody's probably been listening. First, the Fed's prolonged misjudgment of inflation dynamic means that it now has to move virtually simultaneously with three measures that reduce monetary accommodation, greatly increasing the risk of a policy misstep. I'm sure they'll screw it up. Second, the withdrawal of accommodation risk coinciding with other contractionary winds emanating from de facto fiscal tightening and the erosion of household savings, threatening a bigger reduction in the momentum of economic growth. Given the extent to which the Fed's record injection of liquidity has boosted asset prices in the last few years, it should come as no surprise that the prospective reduction of that liquidity is causing anxiety about the prospects for a fourth consecutive year of double-digit returns for U.S. stocks. Whether it will lead to outright losses depends in large part on whether the second driver of the everything rally, that is behavioral, will be reversed. Dips and more dips. For quite a while, the Fed put has deeply conditioned investors and traders to buy any and all market dips, regardless of their cause. It is a behavioral aspect that has been reinforced by FOMO, fear of missing out on yet another set of record highs for markets. And TINA, there is no alternative to risk assets given how repressed yields are. All this has contributed to dips that have become generally shorter in duration and less intense in magnitude. While Wednesday's signal from the Fed call further into question the automatic nature of the Fed put, they have not fully altered the behavioral conditioning. Indeed, there is still a significant segment of the investor base that continues to believe that when push comes to shove, the Fed will prove either unwilling or unable to validate current expectations about monetary tightening. After all, the Fed was forced to U-turn back towards accommodating several times in the last decade, including most famously after the so-called taper tantrum of 2013 and again in January of 2019. Yet for this to happen again, this time around, inflation would need to come down materially. In the absence of that, the Fed would risk destroying its already tarnished policy credibility. As I suspect, despite recent moves, the central bank is still lagging economic developments on the ground, and it is probable that its policy signaling in the next few months will further undermine markets' notions of an automatic Fed put. The big question for the economy is whether policy actions by a Fed forced to play catch-up will end up so bunched together as to cause too abrupt a change in financial conditions. The additional question for the markets is whether the longstanding conditioning to buy the dip will prove strong enough to withstand such a notable change in the liquidity regime. So, yeah, I do have to agree with this gentleman that we probably should have started tapering and reversing all of this liquidity a long time ago. Granted, in my opinion, I think the thieves in Washington are simply just looting the taxpayer at this point, with inflation and all the government spending for the jabs and the testing. And I mean, it's just money is flying out the door faster than we can print it. All righty. Next article here. Is it time to fight the Fed? This veteran strategist says the central bank won't risk a 20% drop in house prices and a 30% slide in stocks. All right. Who wrote this? Let's see. This was written by Steve Goldstein. The bond bears have been in ascendance this week, even before the release of the latest minutes from the FOMC. The yield on the 10-year Treasury has jumped 23.7 basis points this week, the largest four-day yield gain since June 5th, 2020, as the Fed minutes showed discussions of a fast wind down of its balance sheet along with rising interest rates. Granted, this was a discussion from December 14th and 15th through though St. Louis Fed President James Bullard's comments on Thursday suggested the more aggressive stance outlined in the minutes was still very much current thinking. David Rosenberg, chief economist and strategist of Rosenberg Research and former chief North American economist at Merrill Lynch, isn't buying the tough talk from the Fed. One should be skeptical of the Fed's forecast, given the poor track record, even though investors treat them and the dot plots of the FOMC as gospel. Dating back to 2012, the Fed's forecasts on rates have been correct 37% of the time, accurate on core inflation 29% of the time, accurate on unemployment 24% of the time, and accurate on real gross domestic product growth 17% of the time. And the Fed tends to be bullish on growth, he adds. What I'm saying is that they say the stock market never bet against the Fed, but bet in the bond market. I can definitely tell you that it's perfectly safe to say that you can bet against the Fed's forecast ability, especially when it comes to the one thing the Fed can actually control, which is the policy rate, he says, pointing to flattening real consumer spending, housing past its peak, too much inventory, a record high trade deficit, and a flat to down real business speaking. There is absolutely no impetus to domestic demand growth going forward, and yet the Fed continues to play the role of economic cheerleader. If the Fed were to hike to 1.75% next year, it would mean the possibility of a 20% decline in home values and a 30% slide in equity prices if there were a mean reversion in price to income ratios. Even now, both asset classes are overpriced by 15%, he says. He recommends in the stock market shying away from cyclical sensitivity and towards defensive growth, such as healthcare, staples, and utility, and in corporate credit trading up in quality. Cryptocurrency crime reached a record $14 billion last year, according to the research company Chainalysis, with scammers taking $7.8 billion and outright theft of $3.2 billion as a percent of all transactions. However, the company said crypto crime was at a record low since. Why does this matter? So, the U.S. created. So, anyways, So basically, I think what the in this first section here, what the gentleman is talking about is that the Fed will probably reverse course, and I think I do agree with this person. As soon as we get to any sort of shaky waters, the Fed will probably start dropping interest rates and begin their purchase of toxic assets, just like they've done really the last, I don't know, 12, 13 years. So I don't know. At some point, the money's going to run out and the bottom's going to fall out and it's all going to go to crap. But until then, I guess we can continue to try and make a buck off of it. All righty. And then the last article I have here is an opinion article. Social Security blows it again. This is by Brett Arends. All right. Social Security has another disastrous year in 2022, even as it hurtles towards insolvency. America's main pension plan saw its investments badly trail the booming market's competitors and even inflation yet again, thanks to rigid investment policy that hasn't changed since 1935. The trust fund earned just 2.5% on every dollar invested last year. The trustees have just revealed that compared with the stellar year of financial markets, where the S&P and the Dow Jones, they were up quite a bit, but how much of that is just pumping cash into the economy? So, to me, it seems like a false lift. Granted, 2%, you would think that with the money they're investing, they could probably get a better return. Nearly all U.S. workers were compelled by law to pay 12.4% of every dollar they earn into the Social Security Trust Fund. Yet last year, their money earned just a quarter of the returns of the typical global pension plan and just 1/6 of what they would earn in a basic Vanguard Balanced Index. The funds were also less than half of the rate of inflation, meaning in real life purchasing power terms, workers lost about 4% in their money. Social Security's investments have underperformed basic pension plans, basic pension fund benchmarks in 4 of the last 5 years, 8 of the last 10, 11 of the last 13, and in 2/3 of all years since 1980. The average underperformance during the past 4 decades has been about 4.5% per year. The plan is required to invest 100% of its money into U.S. Treasury bonds under the terms of the 1935 law that created it. Almost no other pension plan in the world operates like that. The rest invest mostly in profitable stocks, real estate, and other assets. The typical U.S. pension plan, other than Social Security, keeps about 80% of its money in stocks and alternative investments such as commodities, real estate, and hedge funds, and less than a quarter in bonds of any kind, including not only safe treasuries, but other things like corporate bonds, which are riskier but earn higher returns. Unique treasury-only policy was set by the Social Security Act of 1935 at a time where stocks were out of fashion. The U.S. was still reeling from the aftershocks of the Great Wall Street crash of 1929 through 32, when U.S. stocks fell about 90%. President Roosevelt had another reason for keeping the new program's money in U.S. government bonds. It provided easy money to help pay for the New Deal, but the policy has proven disastrously costing the trust fund and workers who rely on it since the mid-1930s. U.S. stocks have outperformed Treasury bonds by a total of 6,000%. The average big U.S. pension plan, other than Social Security, is today expecting an average return of about 7%. Last month, Social Security was invested in all new FICA taxes in bonds paying 1.5% interest. So Social Security's disastrous investment returns come as the fund braces for crisis and possible insolvency. In 2022, the trustees reported that the hole in the fund's accounts has grown by $3 trillion in the previous 12 months, the biggest annual rise on record. Social Security is now underfunded to the level of $20 trillion, or nearly 100% of U.S. GDP. Unless drastic action is taken, benefits will have to be cut benefits will have to be cut by about 1/5 across the board starting in a decade. Such a drastic action is expected to include tax hikes and benefit cuts. The last time this happened, in the 1980s, the government responded by walloping Social Security beneficiaries with benefit taxes for the first time. If the trust fund had been invested in a regular mixture of stocks and bonds throughout history, like every other pension plan, there would be no funding crisis. About 65 million Americans currently receive Social Security benefits. Most are retired workers, though they also include widows, orphans, and those with disabilities. Another 175 million Americans currently pay into the system. Despite the looming crisis in Social Security, many of the underlying principles are currently subject to little policy debate or political debate. There is, for example, little or no political pressure to change its made in 1935 investment strategy, even though it is been provably disastrous, and no other comparable pension plan pursues such a strategy. Equally, there seems little demand to the end in the system whereby Social Security is financed by the flat, even regressive 12.4% income tax, even among people who otherwise consider all flat taxes obnoxious. The result of is that someone in minimum wage must hand over 1 out of every $8 they make to an investment operation that's designed by law to lose money, and nobody says a peep. Not even those who complain frequently about how hard it is to keep the body and soul together on minimum wage. If Social Security hits insolvency, both liberals and conservatives in politics can be expected to try to turn the crisis to their advantage. Well, that won't shock me. As someone once said, you never let a crisis go to waste. I believe that was John Podesta. Meanwhile, few of those in political class will be affected personally when the crisis arrives. For those connected to the Beltway, their wealth, federal salaries, outside incomes, and matchless contacts mean that a future Social Security cut, even of 20% or more, will barely register. So, yeah, I personally, we could have fixed this decades ago. The fact that the people who run things are just allowing this to careen off the cliff and, Thelma and Louise style, and then crash into a fiery, explosion. You know what? I don't care at this point. I hope it goes bust. It's going to be hilarious when everyone is bitching and moaning that they're broke. And I'm just going to sit back and say, I told you so. It's kind of like a lot of things the last 2 years. I'm being proven right left and right. Masks, mortality of this so-called disease. So anyways, all right, not enough. I'm done gloating with that today. So hope everyone has a fantastic weekend. I've managed to only ramble for 27 minutes. So hope everyone has a fantastic weekend. I will be back on Monday with the weekly economic update. And if anybody needs anything from me, don't hesitate to reach out and drop me a call or an email, and I'll get back to you as soon as I can. So like I said, hope everybody has a great weekend, and I'll talk to you on Monday. Bye-bye.